Good morning, good afternoon, good evening, and welcome to the very slightly delayed start of the morning webinar here, the Bull versus Bear webinar in here. Morning if you're in the US, and just coming up to midday in here, or 11:30 here in the UK. The Bull versus Bear webinar today, Tuesday, 14th of March. Steve Miley on the call for TradeDay.com. Welcome, everyone. Welcome. Right, we're going to go through usual regular run through in here today, calendar, what we've had, what we've got coming up. I'm going to mostly focus on a load of articles about SVB, and then also focus on the whipsaw price action in the interest rate market, particularly the short end. We'll look at the CME tool. I'm going to take a good run through that today, and we'll look at the bond markets and the absolutely huge moves we've seen in short ends. US 2-year yields, biggest 3-day move since the 1987 Black Monday crash. German government 2-year bonds had their biggest one-day move ever yesterday. Okay, biggest one-day move ever. Obviously, this is all moving to lower yields. Okay, so biggest one-day move ever in German government bond yields yesterday. 2-year government bond yields, that was. So huge moves. So it's not just US. It's not just this is spread. This is global, and has impacts for not just the Fed but for global central banks and global way the global central banks are going to approach. They're dealing with inflation over the next weeks, months, and maybe the balance of this year. Let's take a look very quickly, though. We do have data, which seems to be considered as the biggest data event now, arguably, of the month. The CPI data. Given that the CPI data is arguably the biggest data event of the month, over payroll and employment report, because of obviously the big focus on inflation, and we have that CPI data coming out in just under 1 hour's time. It's almost a little bit sidelined. I mean, obviously the market's going to react to it. Well, what we really don't want to see is a really inflationary number. I mean, an uptick in inflation would be kind of disaster, because it then tells the market, well, we need to be hiking rates, but we don't want to be hiking rates. And it causes, what we would really like is to see, if inflation starts to temper, I think you see a massive dovish pivot from the Fed, okay? And that's what the market's calling for. So I will just run through a lot of these articles. I've got about 10 plus articles in here. I'm not going to go through them all. I'm just going to go through the headlines, but just what's happened, and what to be watching, really. I mean, equity markets, let's face it, haven't moved a lot, really. What were we, 1.5% down on Friday, got the rebound bit yesterday, then gave up to new lows, and then we managed to push lower again to new lows yesterday, but then rebounded, and then slightly rebounding again in here this morning. So choppy, but I mean, hardly a disaster, right? It's hardly falling apart in here. Obviously, stocks of banking stocks are significantly lower. The banking sector's lower. Regional banks are getting hammered, but generally speaking, you would say the broader stock indices are actually holding in quite well, and they're holding in quite well because there's an anticipation. The market is almost demanding the Fed temper everything they're doing, and global central banks. We've got the ECB on Thursday ahead of the Fed next week. The ECB are due to hike rates by half a percentage point on Friday. That's what the expectation is. Are they going to do that? Possibly not now, right? So there's a lot of talk about the Bank of England, not moving at their next meeting, okay, where previously a move was expected. So we've got lots of this is global. It's not just a small regional bank in the west of the US, and it's a lot more than that. A third bank has failed. I saw the headline. I don't know what that bank is. That was new to me. Signature Bank to junk now. The Signature Bank was the third biggest failure, but I saw the headline. Where is the headline there? So it's 3-day bank still weak. I don't see it, but maybe I missed that. But I did see third, and then and also a lot of focus on Credit Suisse at the moment. Credit Suisse has been in trouble for a while, right? I mean, looking to float off various parts of its business in here, but there's concerns that this goes elsewhere. So I'll find that article as we go through. Let's go through, but let's first focus on what we've got coming up. So we've got the inflation data. Okay, Bowman speaks. This is a bit odd. Bowman speaks in here. I'm not quite sure how Bowman is speaking, given unless it's like a non she's not allowed to speak to about anything regarding interest rate policy. I don't know, because we're in the blackout period at the moment. Here's the blackout period. Blackout period, the 2 Saturdays before the meeting. And the meeting in here, where are we? March 23rd. March 23, excuse me, 21, 22. We're on blackout from the 11th. So I'm not quite sure. Let me just see and here on the Fed speakers list. Fed speakers, is that going to work? Yeah, calendar. What is today? The 14th, right? 14th of March. Yeah, Bowman, the innovation. So maybe kind of, she's not allowed to speak about interest rates. I don't know, but I mean, it's going to be, if there's any Q&A in there, right? She's going to be, look, modernizing the US banking system is what she's talking on. Unbelievable. In Hawaii. Nice for her. Wow. Yeah. So she's talking on the US banking system. How's she going to talk about the US banking system today when 2 banks have failed? Without mentioning that. That could be interesting. That could be interesting. And maybe they use that. Maybe the Fed used this from Bowman to kind of send us a message, right? We're also looking for maybe leaks they often leak into the Wall Street Journal. I'm going to come back to 5 things, but we haven't got CPI. It probably could move markets, but any kind of further fallout, any kind of hints from anything going on with regard to the backstop that's been put in by the Fed and others, Fed Treasury, that's been put in. Effectively, reading some articles. I don't think I'll pop the articles out in here today, but the Fed have de facto gone to a new bout of quantitative easing. So are they going to keep tightening rates as you go into quantitative easing? No, Nomura, I don't know if it was in the 5 things to start your day on the European edition. Nomura calling for a rate cut. Goldman Sachs looking for no change, I think, now. And there's been various calls now for no change. So let me have a look at it. And the biggest US banks, the big names, okay, JP Morgan received billions of dollars in recent days. Bank of America, Citigroup, Wells Fargo seeing higher than usual volumes. People taking their money out of the regional smaller banks and putting them into the big 6. Okay, so JP Morgan, Bank of America, Citigroup, Wells Fargo, etc., all receiving large inflows in here. So that's not a surprise in there. So first, all these have been put on a downgrade. Okay, First Republic, Western Alliance, Intrust Financial, UMB Financial, Zion Bancorp, and Commercica. Commercica? Yeah, I think that's right. Comerica. Oh no, Comerica, right? Comerica, all on review. Okay, some of these names are new to me. In reference to First Republic, Moody said if it were to face higher than anticipated deposit outflows and liquidity backstops proved insufficient, the bank could need to sell assets. Okay, so concerns there. Credit Suisse down again. And more concerns about Credit Suisse. Nothing to do with SVB, but I mean, nevertheless, last thing we need is another banking issue coming from somewhere else in the system. So, yeah, all of that. So that's all about. Yeah, that's all just about the outfall from SVB. So I mean, we do have the CPI figures, but I think what we get, the continuing, and also what the interest rate market is pricing in, that is what is really critical now. Let me just run through some of these other articles in here. So US futures ride, Treasury is actually falling, down in price, back actually higher in yields, having had a huge move to lower yields before the data. And actually US regional banks have rebounded after brutal sell-off. Okay, so we're actually seeing a rebound in here this morning. 6 shot. I'm going to share this one. I don't know whether you can access this, guys, whether this one, I've got a subscription in here to Bloomberg. If you only look at a few articles a month, I think you get about 6 free articles or something from Bloomberg a month. Take a look at this one. This is good. I went through it this morning. But basically just looking at different charts to just highlight. I mean, this was a thing that the largest 3-day decline since 1987 in yields for the US 2-year. And as I say, German 2-year yields moved the most they've ever moved yesterday. So, I mean, huge moves in here. CBOV, the fear index, the VIX in here surged higher in here, back above 30. First time since 2022, the VIX back above 30 in here. So, often seen as a gauge of fear in here. Yen strengthening against the dollar. Okay, so dollar yen in here moving significantly. Yen as the ultimate safe haven. Seeing moves in here, and gold higher, actually gold pushing significantly higher in here as the ultimate safe haven. So yeah, I think that's a useful article to look at. Oil, we're not, obviously the direct impact on oil is negligible, but the fact that this could all see a slowing in the global economy, it just goes through all markets. Risk off, oil down, right? So but yeah, some more in here. Gunlach in here predicts Fed will pause rate hikes after March, and we're going to look at the CME tool shortly. I want to run through that and show you some charts on that, but it's certainly looking more that way. We could see a pause. With the CME tool is actually pricing in rate cuts, and for rates to be lower than they are right now by the end of the year. Unbelievable, considering we're looking for a point up in rates only after Powell last Tuesday. We were looking for rates to go between 75 and 100 basis points up from here and then stay there. The market had then priced in no rate cuts. Having been previously pricing in a hike to like 5.5, and then moves to 5.5, and then down from there. Then the market moved to pointing to almost getting up towards 6%, and now and then no cuts, and now the market pricing in maybe in here potential for only another 25, and then go on pause, and then potentially cuts into the end of the year. Okay, all on the aftermath of this. And there's also a thought process in here that this is naturally going to slow inflation, right? This is enough, to maybe slow inflation. This shock to the financial system, enough to see inflation slow down, enough to curb demand. So this is a good one as well. I only skip read this, okay, but this is basically previous policy responses today. Historical templates for Fed policy actions as it reviews financial risk in here. Alan Greenspan there, I consider him my Fed chair from my time in the business. I think that one's worth looking at if you can get hold of it. So if you can read that one there, take a look at that. I only read it a little earlier on, but I mean that it looks quite good. I'm going to go back and read that. Futures steady. So futures markets in here having had, this is the index futures in here, not really moving. Actually hanging in fairly well. Banks started to rebound. Obviously, inflation in focus. Moody's has downgraded Signature Bank to junk. 6 different banks under review. SVB shocks those rattle global banks. Nothing you don't know in here from these headlines. Encrypts a contagion. And say it is contagion risk. We've seen for the Norwegian sovereign fund, the sovereign fund, the actual fund of the Norwegian government in here under pressure because they own SVB stocks. So or debt or credit, I'm not quite sure, but under pressure from that. JP Morgan seeing big inflows in here on the back of that in here. A casualty in a battle between fire and ice against inflation bankers here. Okay, so this is quite interesting. Okay. So the Mac of Silicon Valley Bank and the market told at least part of the battle between fire and ice in global efforts to curb inflation. Okay, Morgan Stanley, co-president, said. Okay, steep rise in interest rates by the Federal Reserve and other central banks to combat soaring consumer prices inevitably led to flare-ups of stress. So basically pointing to the fact that we've had aggressive interest rate hikes on the back of the fact that we need to tackle inflation. Okay, has put stresses on financial markets. Okay, and the financial system. Okay. This is part of the process of not being turned to tighten financial conditions to make sure that we're on our way to normalizing a higher interest rate world. Okay. But there might well be surprises. There might well be reactions. Okay. Basically saying in here that, this is a consequence of the higher interest rate moves that we've seen in here over the last year or so. European stocks stabilizing after 3 days of a rout, and banks though remaining weak. And you can see in here, European stocks slightly rebounding here. FTSE is pretty much unchanged. The DAX and the CAC, the German, the French indices slightly higher. And then if we take a look at the US stocks in here, we're kind of mixed yesterday. I think the S&P actually ended up slightly up on the day. The Dow was slightly down, Nasdaq slightly up, and we're up about 0.5% across the board. Slight rebound in here this morning as things start to calm. Right, I'm going to spend most of the time here focused here now on. I think this is interesting. This column over here wasn't here yesterday. I can't remember if I came on with you guys and looked at the Fed tool. I think I did. We had a column here though. The column here is the 50 basis point hike. That's not here anymore. Okay. No probability of a 50 basis point hike being built in. This is the probability of a 25. This is a probability of unchanged. Okay. The market now gravitating towards a potential for unchanged. Okay. And so some commentators are, calling for a cut. I think that's very speculative. I don't see that happening. But nevertheless, in here, unchanged. We could easily be unchanged next Thursday. As we said just earlier on, right, Bowman, are we going to get something leaked from the Fed? We do have Bowman speaking today, during a, effectively like a blackout period. I assume it's because don't mention interest rates, in that speech. But then, maybe they kind of get around it. I don't know. Particularly as she's talking about the banking system. I mean, how do you not talk about it, right? So, that's going to be interesting, right? So maybe we get something from the Fed. Maybe the risk is we get no change, right? But I think what's even more interesting than this is you go further out the curve. So remember, we're currently at 454.75. So the market's still pricing in up 25. Okay, if we go to May, okay, looking for another 25. Okay, up to 225s. Okay, to 505.25. But then we get to June, it's back here at 475 to 500. Right, so back down again by June. July 454.75. Okay, that's where we are now. Okay, September 420, between 425, 450 and 454, so even Steven split between maybe a rate cut, and then by the time we get to November, 425 to 450, that's 25 down from where we are now. So the market kind of undecided. Are we going to be up 25? Are we going to be up 50 over the next 2-3 meetings? Are we actually then going to go on pause? Are we actually going to be cutting rates by November? And by December, it's actually nailed on that we've got, pretty much a rate cut in the bag. Okay, so looking to be rates, and not only a rate cut, but actually rates lower than where they are right now. Okay, this is a huge potential dovish pivot. Maybe the impact of everything we've seen so far since last Thursday, Friday, does end up slowing inflation down in its own right. Maybe it tempers the consumer. The consumer's more concerned, worried about their money, right, kind of stuff. Maybe corporates are a little bit more concerned. They're kind of a little bit more cautious. Maybe it slows the economy down. Okay, this could slow the economy down quite easily in its own right. This little shock, slow the demand down, ease off inflationary pressures, and we could naturally see inflation correct more because of this. So the Fed don't need, and the last thing the Fed want to do is put extra pressures on the system, and raising rates is putting extra pressures. I would not be surprised at all to see this column a lot higher before next week, and I wouldn't be surprised if the Fed don't move. What's wrong with what's in the what the downside if they don't move, right? Then they just have to be more aggressive going forward if inflation doesn't cool. If they do move and cause more stresses on the financial system, that could see a massive implosion, right? And that's the last thing they want, right? They're cautious. They're naturally conservative. My view is that they will pivot to no change, okay? And I think we'll see this column go up. And what is holding up stocks right now? The stocks are being held up by the fact that all of this, even though it's negative, right? It's clearly negative. The fact that it's going to end up meaning that the Fed, and not only the Fed, remember, this is global central banks, right? The interest rate curves, if we had the equivalent of this tool that we have from the CME for the Euribor, which is the short end of the interest rate in Europe, and the short sterling curve, if we looked at those, right, I can tell you they're showing the same thing. Ebbing chances of a more aggressive mood from the central banks, global central banks. So we're going to see the Bank of England maybe more cautious, the ECB, the Bank of Australia, the Reserve Bank of Australia, New Zealand, Canada, everywhere else, all the major policy centres are likely to be more cautious. They're not going to want to try and increase the threat of any kind of contagion in the financial system. We know what happened in the global financial crisis. Okay, the risk is, and this backstop they've put in is effectively quantitative easing by another name. So why would they be doing that? At the moment, they're reducing their balance sheet. Why would they continue to reduce their balance sheet on one side and then increase it on the other side? Okay, it is emergency backstop, but nevertheless, and then why would they be hiking rates when they're trying to put up funds in place and put liquidity into the market? It makes more sense to not increase interest rates. And I think that the markets, when I say the markets, the equity markets, the stock indices are going to like that. If this continues to pivot towards maybe no rate hike, that they go on pause now. If there's any kind of hint they're going to cut rates, right, which is very, 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 very unlikely, in my opinion. Okay, but if there is any hint of that, if there's a hint they're going to pause, I think stocks could fly higher. Just broader stocks. Okay, the banking sector is going to stay under pressure. They could easily fly higher. So yeah. That's my 2 pennies worth. A real quick look at the charts in here. I think you have to in here keep an eye on, but then again, you keep an eye on the treasuries, right? which way. It's not really. There's no correlation in here. Look what's happened on treasuries, all the way up, and then a big pushback lower in here this morning. And then how does that correlate in any way? So in some ways it is an important market at the moment, but how does that correlate with what's happened here, right? Down and then up. So maybe if we go back down, perversely almost, if we move back down in price, which is higher in yield, higher yields are going to send stocks higher. How does that work, right? We've been seeing the complete opposite of that happening, more recently. Yeah. So I don't see that happening. I just don't see. I think that correlation is broken for now. It's very, very difficult to see, because we certainly don't want to see yields moving. We want to maybe yields move back slightly to show that there's less stress. Okay, we want to see lower prices, higher yields for showing less stress in the system. But we don't ultimately want yields going higher, right? Stocks don't want higher yields, so it's a difficult one to know if to track that or not. For me, I think there's that yesterday. That's a long-legged doji. I did the technical Tuesday a couple of Tuesdays ago on candlesticks. Another long-legged doji, a positive one here on the Nasdaq, and a negative one on the. But nevertheless, what they see, that long-legged doji signals a potential turning point, and we're obviously in a downtrend, not only from the beginning of February, but the acceleration that we saw from the beginning of March. So this long-legged doji, a potential turning point. Where's it coming off of as well? It's coming off right near the lows in here that we posted from the end of last year. The lows from the end of last year on the S&P, and on here, nowhere near those lows in here, much higher point, but coming from above that spike low there from the end of January. Long-legged doji, potential turning point, and we're seeing this turning point. Even though in my reports I kind of favoured. What does that long-legged doji look like, and what's the price action? Well, you'd argue this is potentially an inverse head and shoulders, right? You've got a bigger downtrend. You'd argue this is potentially an inverse head and shoulders. That's on the Nasdaq on the 15-minute. The neckline runs across here. You could get in a bit earlier, but I would, really want to wait for it to clear above the peaks. So between 12,085 up to 12,110. If it clears above there, this could be off to the races on the upside. Really could. And similarly with the S&P, not quite as positive in here. It's not really an inverse head and shoulders. Really above that peak there. I think that's yesterday's peak. The peak there, 39.08 through 39.08 opens up the upside back up to these peaks over here at 38.42 area. So 39.08 would be my level in here. If it cuts back below the lows here, 38.54 area, 54.5, looks more negative. Okay, but potential. This looks like a basing structure. This looks like a basing structure on the intraday. On the daily, you got the long-legged doji, and similarly, inverse head and shoulders there on the Nasdaq, and then long-legged doji on the candlestick on the daily from yesterday. Both of them signaling potential turning points, maybe shifting more bullish. All right, guys, I'm going to wrap it up there. Any questions? Anyone got a question? No questions? You can put it in the chat just below where you're watching the streaming. No? All right, guys, I'm going to wrap it up there. I'm going to wish you all a great trading day. Take care. Stay safe. I'll be back with you tomorrow for another bull versus bear webinar. Take care until then, and have a great trading day. Bye.